Wisconsin is sort of the neglected stepchild of tax law in the sense that we tend to spend, extraordinarily a large percentage of our efforts on federal. And then Wisconsin tends to be an afterthought, and that's just the kind of the nature of the beast. That tends to be the way I've always seen it go down. But, I like to think of it in terms of we're producing two tax returns, and they're both significant. They both can bring a lot of benefit to taxpayers, but a lot of risk also to taxpayers. So they need to have a decent amount of attention to each. So, and I also say, I went into TaxSlayer last night and today. It appears that Wisconsin is a bit further down the road in terms of its deployment. Aaron, guys, is that about right? We're seeing Wisconsin. And I'm going to be honest with you. I'm very much a fan of TaxSlayer on the federal, but we need to be careful with TaxSlayer on Wisconsin. I saw some things that I thought it would do for us that it wasn't doing. So it's not going to be, Wisconsin will not be, and really never can be, but to a large enough degree that we need to be careful and we need to be mindful. Wisconsin is not a slam dunk in TaxSlayer. So we need to know what we're about here. The approach I'm going to take is to go right to the actual forms. And so I'll just click on Form 1, and hopefully it'll work. Yeah, looks like it's going to. Good. And this is the actual Form 1. Now, this version of it happens to be the version that is a fill-in form, meaning that someone could go to this and actually fill in forms, They can put in an actual name into these. But that doesn't really make a lot of difference for us today. It's just simply a Form 1. Now, I'm going to do things real quick. In fact, I should have done it like that, where it's last name first for Wisconsin. But just kind of take a quick tour through a Form 1 just to kind of give us a feel for Wisconsin. Wisconsin is going to, in nearly every case, follow the federal filing requirement. Notice the tax district. Now, TaxSlayer does a great job of this. We'll see it when we work the return. Here's sort of the key concept, and that is that Wisconsin starts with federal adjusted gross income. That's the starting point for Wisconsin. And then we're simply adjusting federal income for the quirks or the specific provisions that Wisconsin has their own. If we saw the tax code as being like this, okay, Wisconsin is going to change about this much of it. By and large, the federal code is the way Wisconsin views the world from a tax perspective. But there's that slice of difference. And that's really what we need to know. We need to know the slice of difference, or at least the top 10 differences. And then we need to know what TaxSlayer will do for us automatically. And frankly, last time I went into TaxSlayer a week or so ago, Wisconsin wasn't doing much of anything, and now it is. So I haven't spent a whole lot of time with it. We're going to learn that together, guys. What TaxSlayer will do for us versus what we need to be inputting ourselves. Okay. Now, but the high-level picture is start with federal income, make various additions to federal income, meaning things that are not taxed by federal but are taxed by Wisconsin. And one of the main items would be state and municipal interest, what we would call tax-exempt interest. And by the way, when we code it tax-exempt interest on federal, it does not automatically create an addition on Wisconsin. And that makes sense because there's certain interests, not much, but there's certain interests that can be exempt for both. But usually, the interest that's not taxable on federal is taxable to Wisconsin, and we need to add it here. So start with federal AGI, make some additions, come up with a subtotal, and then make a bunch of subtractions. Now, we'll look at kind of the greatest hits as far as these subtractions in just a moment. Okay, so federal income, additions, subtractions, and then arrive at Wisconsin income. From Wisconsin income, we'll take a standard deduction. Now, standard deduction for federal is just flat based on filing status and age and vision. Whereas the Wisconsin standard deduction is based on income and filing status. So the Wisconsin standard deduction for me is different than it is for you. Okay? And everybody in the room, really, in a sense, we've got our own Wisconsin standard deduction because all of our incomes are different. We then take exemption amounts. And we take the exemptions from the federal return. That would be both personal exemptions for taxpayer and spouse, and those dependent exemptions we talked about last week. And then we're going to add a bit if they're 65 or older. So Wisconsin income, which again, federal income, modified for Wisconsin-only additions, modified for Wisconsin-only subtractions, equals Wisconsin income, minus standard deduction, minus exemptions equal Wisconsin taxable income. With Wisconsin taxable income, we'll go to tax tables and we'll look up a tax. Itemized deduction credit. There's only a few things that qualify for the itemized deduction credit. And there's certain things that aren't. On federal, we can take taxes as an itemized deduction, like property taxes and state income taxes. They do not work for Wisconsin. On the federal return, we can take some miscellaneous deductions like employee expenses or expenses for investing. We can take, they're called miscellaneous deductions. We can take those on federal. Well, gambling losses is another. They don't work for the itemized deduction credit. So not everything works for Wisconsin in terms of itemized deductions that work for federal. Notice that this is a credit. It's an itemized deduction credit. Credit being a dollar for dollar reduction in our tax versus a deduction, which is a reduction in our income that's subject to tax. So very different. Deduction and credit, very different. School property tax credit. Now, that's based on rent paid and based on property taxes. Now, we're going to talk about homestead credit in a minute. These are two separate credits, and you can get both on the same dollar. So you pay $3,000 in rent, you can get a school property tax credit for that rent. You pay $3,000 in rent, you can also get credit on homestead credit for it. Okay, it works for both. They don't sort of knock each other out of it. They're not, to use that term again, they're not mutually exclusive. Working families tax credit, that tax layer should almost certainly deal with that, and that basically exempts lower income people from paying any Wisconsin tax. Now, this is one I wanted to point out. It's the married couple credit. Now, you don't really get a credit for being married. That's not the idea. The idea is that when married people add their incomes together, they get pushed into higher tax rates. And there's something called a marriage penalty because of it. This credit is meant to offset the impact of that marriage penalty. And it's based on income of the spouses. So if you had one spouse who earned $40,000 a year and the other spouse who stayed at home and took care of things at home and had zero income, there would be no married couple credit. It's based on the incomes of the spouses. We take the lower and then calculate the credit based on that. And the reason I point this out, guys, is that TaxSlayer will compute this for us, but we better code those W-2s correctly. as far as this one belongs to the taxpayer, this one belongs to the spouse. Because if we don't code those right, the married couple credit will be wrong. If we code them right, then the married couple credit will be a done deal for us. I'm almost certain of that. I haven't really tested that theory. I'd be shocked if that wasn't the case. Just really just shocked. We're going to need to answer, I believe, at least last year and other programs I've seen, we need to answer about sales and use tax due to out-of-state purchases. You know, it's kind of a weird rule in that if I buy, you know what, Delavan and Woodstock. You know, Delavan's just on this side of the Illinois border, and Woodstock, Illinois is just on the other side of the Wisconsin-Illinois border, right? And if I buy an air conditioner in Delavan, I'm going to pay a sales tax. If I buy an air conditioner in Woodstock, I'm not going to pay a Wisconsin sales tax because it's an Illinois purchase, but I am subject to Wisconsin use tax on it. So even for internet purchases, and I probably should have used internet as a better example, but for internet purchases where we're not being charged sales tax, there still is a use tax out there that Wisconsin's going to collect. Now, do they collect every penny that should be done? Well, almost obviously not. But that's what that question is about, and that's sort of the relevance of that question. All right, now notice that there's a Wisconsin earned income credit that should be calculated automatically, I think, for us, and then we've got homestead credit, and that's what I want to spend some time on right now. Before we go further, questions, concerns? Let's talk homestead credit. Homestead credit is a very specialized sort of area. It doesn't get nearly the kind of attention that it deserves. A lot of our customers, a lot of our taxpayers are going to be eligible for homestead credit, and it can be pretty darn complex. And I would say that we probably, we should strive to be as knowledgeable about it as possible. All right, let's define some terms. They're not as obvious as we may think they are. Homestead is a Wisconsin home, whether owned or rented, up to 1 acre of land, but can be up to 120 acres if it's part of a farm. Okay, that's homestead. Wisconsin home, rent or own. Farm is defined. Household, and this is the part I find more interesting. Household. Household is a claimant and their spouse. If single, you are a household whether you live alone or with others. So if we've got 4 23-year-olds living together, we've got 4 households going on within that one homestead. Okay, but taxpayer and spouse, one household. One interesting thing comes in if people are married during the year, and let's say they lived together before they were married. They really have 2 households during the year. For one part of the year, 2 households, and then when they get married, 1 household. Only one of them can file homestead. And really one of them is kind of knocked out of it. So household is interesting in terms of marriage during the year, but it's also interesting in terms of people who are unmarried living together. We have multiple households within one homestead. Household income is all reportable income plus a whole lot more. Basically, household income is both taxable and non-taxable income, but there are exceptions to that, right? So we can't make that an absolute blanket statement, but we can make it pretty close to a blanket statement that it's taxable and non-taxable. Yeah.
Well, we see a lot of people that come in with Social Security income only that get the homestead credit, which is kind of, a lot of people would just say you don't have a filing requirement, but the homestead credit is a big thing for them.
Right, so. Absolutely. So they're folks, they have no legal requirement. If they don't show up, they're perfectly legal, right? But they want to file it.
Right.
And Social Security is part of household income, isn't it?
Yes.
Yeah.
Now, are you saying if you own a house and it's on 6 acres, you can't qualify?
No. What we're saying is if it's 6 acres and it's not part of a farm, that they need to prorate the real estate taxes to consider the improvements plus the taxes on 1 acre of land. So a $1,200 tax bill might get shrunk down to $980. That's what we mean. Now, Wisconsin Works. Wisconsin Works is a two-edged sword. How do people get this? It's not kind of like the old days.
We don't have a lot.
It's not like the old AFDC days.
Never saw.
Well, okay, I won't spend much time on it, but it doesn't sound like we're going to see a lot. But if people get W-2, which is sort of it's welfare, I guess. That'd be the street term for it. It not only is part of household income, but for any month that they get W-2, I believe. In fact, you know what? I better not say what I'm about to say because I may be thinking about old rules. I'm not going to say it. Okay. All right. Let me go back here. All right. Let's look to page 11 of our instructions. Oops.
And just to let you know, we will have copies at each site of Schedule H instructions, Form 1 instructions. It's something that you can access online from the Department of Revenue webpage, so if it's something that you want to be poking around with this week or even just have as a favorite on the computer that you use so that you can personally access it really quickly. But do know that these materials will be available as a resource at the site, so you have a paper copy you can leaf through. We just didn't order enough for everyone.
I'm gonna make a statement, and this statement is this. I said it I think I said it to some extent last week. If you go through our season and you never open up a publication 17, I can almost say for sure you didn't do a great job for us. If you go through the season without opening up the Schedule H instructions, I can say you probably didn't do a great job for us. Okay? We need to be accessing these resources, right? Taxpayers sometimes, they want us to be all-knowing. It's not realistic. We are not all-knowing, and we need to admit it. I'm up here today admitting not being all-knowing. Okay? Not easy to do in front of a room of 30 people, but you got to do it. You got to do it. If you know it, you know it. If you don't, you say it, and you look it up. Okay, guys? Now, we're not going to go through each of these in great detail. What I really want to do is I want to point out to you how important the Homestead instructions are. They are very specific. The Homestead credit is highly rule-driven. You cannot just sort of sit down and try to figure it out in your head. It's what the rules are. For instance, on page 11, if they're named on the property tax bill other than yours, attach a copy of a document showing your ownership percentage. So let's say that we have you've got John Jones in front of you, and they bring in the tax bill, and it says John Jones and Ann Jones. Well, what we find out is Ann Jones is John's daughter, and it's titled that way so that the property will pass to her at death, right? Well, that's fine as far as their estate planning goes, but it's problematic for us in terms of homestead credit. We need to attach a document, and then also what we would do is if John is half owner, we would treat half of what John paid as taxes and really the other half as rent. And that's an example of the specificity of homestead credit. It's really, really detailed. Okay, and we really only know it by kind of getting our nose into the instructions. If we owned it with others, well, that's kind of describing it right there. Mobile homes have their own rules, and we'll look at a rent certificate in just a moment, and we'll kind of get better with that. I mean, we could go, all of these have some interest to them. But I wanted to, I think what I'm gonna do is, in fact, I think time probably tells us that I should probably get moving here. Let's go to the Schedule H.
Bob, can I say something real quick
Sure,
about
John.
that?
Sure, Tom.
When he made the point that the school property tax credit and the homestead are not the same thing, one thing that I always find, and I have a hard time remembering too until we get into it, the property tax credit is based on the taxes you paid for your house or your rent, and the homestead is based on your next year's tax bill. It's based on what you haven't paid yet, but it's based on the, what would you call it,
Yeah.
What
guess
you will
of
owe.
what your property taxes are going to be.
And I'd even say it a little different in that it's based on the 2016 tax bill, which you got around Christmas time, which you'll probably be paying in 2017.
Right.
Yeah, yeah. And that's the idea behind homestead credit, is to help people pay that tax bill.
Right.
That's why we even have the darn thing.
And you'll run into a lot of situations where did they pay this year? Do they pay it next year for last year? Everybody's different. Some pay it in December, some pay it as the year goes on. So that's a little tricky I mean, it doesn't hurt to ask the questions, and it's better to ask the questions and find out what they paid. A lot of them don't remember. They have no clue when they paid it for what.
Yeah.
So it can be tricky, but you can figure it out.
You can figure it out, and often there's resources. We can go to the county or the city or whatever the authority is that maintains that, depending on where we are. And sometimes we can go to a public site and see when tax bills were paid and how much taxes were. We can even print out tax bills. There, it can be really helpful, but some places don't have that capability. Okay, this is homestead credit qualification. They need to be 18 years old. They need to be a legal resident all year. So if somebody became a legal resident in February 2016, homestead credit is not on the table. They have to be full year Wisconsin residents. If you're claimed as a dependent, homestead credit is off the table. Now, the thing about a nursing home, that's very specific. It's if you're in a nursing home, doesn't mean you can't get homestead credit, but if you're in a nursing home and getting Medicaid, or whatever the terminology, it probably doesn't go by Medicaid, but if you're getting if you're both, I guess medical assistance is the term, isn't it? If you're in a nursing home and getting medical assistance, you can't claim. Married or divorced doesn't mean you can't claim it. It just means that special issues arise. I talked about one of them where you've kind of got those two households that then during the middle of the year become one household. Let's see here. We start with Wisconsin income, and then we add in a whole bunch of stuff, guys. Look at, Social Security, unemployment. Now, unemployment, just to make note of it, unemployment is often fully taxable for Wisconsin, which means that it would already be in line 7. It's just those whose incomes are low enough that some of their unemployment isn't taxable, that meaning that it's not in Wisconsin income. If it's not in Wisconsin income, then we need to add it in. But oftentimes it's already in Wisconsin income because it's already taxable. So it just depends. Now, hopefully our program, and in fact, I tested that last night, the program seems to take care of that for us pretty well. In fact, no, I didn't test it. I tested whether or not it's a subtraction modification on Wisconsin. But hopefully it'll deal with it for us. Social Security, railroad retirement, pensions that aren't taxable, and even contributions to pensions, like a 401k contribution. That is part of household income. Interest on U.S. securities, which is normally non-taxable for Wisconsin, includable. Scholarships that we calculated as being tax-free, these get added in for homestead credit. Child support, which is not taxable, right? Alimony can be taxable, but one parent paying another parent child support is not taxable income. It is includable for Wisconsin. Now, TaxSlayer doesn't know that because child support doesn't come into play except for homestead credit. We need to be aware of that. If you see child support and you're thinking homestead credit's in play, remember it, because you're going to need to add it yourself. And then, of course, we kind of talked about Wisconsin Works there. And then really we've got some less known ones. Many of these are going to be kind of beyond scope, and we're probably not going to deal with that. Yeah, Jessica.
Well, I was just like, for the public assistance and stuff like that, if they get like food share and things like that, does that count as household income, or is that a separate, as long as it's
That
not
would
cash?
not. We'd consider that a payment in kind, and we wouldn't need to
Okay.
include that.
As long
Good
as
question,
it's
but
cash.
no, it needs
Okay.
to sort of be cash.
Okay.
Yeah. Yeah. Okay, now notice just the way that this works, and that is both homeowners with their taxes and renters based on a percentage of their rent. If heat's included, we consider 20% of their rent to be for property taxes. If heat's not included, we consider 25% of their rent to be for property taxes. And we add that all up, and then really the way it works, guys, is that we come up with a tax amount. Can't be more than $1,460. Based on their income, we'll reduce that tax amount, and then whatever's left over, we go to another table and figure the homestead credit.
What is the income level this year for the homestead credit?
Yeah, I'm not sure of that. It's like mid-20s, isn't it?
Yeah, it's 24,680.
Yeah, somewhere around the mid-20s.
24,680.
Okay. All right, and then finally, guys, and our last topic won't take us too long, so I think we're going to do okay here. Our last topic for homestead is a quick peek at a rent certificate. And if you describe rent certificates as those blank rent certificates, I understand. I'm with you on that. They can be tough. What rent certificates, what we see, guys, is that the landlords of this great state of ours butcher these rent certificates regularly. We can't work with a butchered rent certificate, at least the part that's the landlord. This part right here, this is our client, renter claimant, right? This stuff is theirs. We can mess around with that. Okay, that's theirs. But landlord part, we can't change it. This is a signed document. It is signed to indicate that what I have indicated above is true and correct. We can't change it. Now, we might look at it and go, I know what they meant. But we can't do it. So we've got to say, here's a rent certificate, go back to the landlord and have it re-signed. Now, in my old world, we used to generally fill them out because we knew what they meant. We'd fill it out and they'd take it to the landlord would sign it and they'd bring it back. That's okay because the landlord is attesting that what we have entered is okay. I mean, we're just making it easy for them. We're not doing it ourselves. They're signing it. And if they have a disagreement with it, they don't sign it. Okay, so we're okay there. But my point is, we can't change this landlord section as much as we want to. And as much as we feel like we would be doing the right thing by doing it. Again, a signed document, signed by somebody else, is not we do not have the right to change it. Okay. Now, just a couple of things here. This is based on rent paid during the year. If they're behind on their rent is $300 a month, $3,600 for the year. They paid $2,400. This line here, 4A, should say $2,400, and that's what we'll base the credit on. Okay, that's one thing to note. If they live in a mobile home, we can have different situations with mobile homes. You could have a mobile home, someone who lives in a mobile home, who both rents the mobile home and rents the land underneath it, meaning they don't own anything. We could have someone who owns the mobile home but rents the land underneath it. And I suppose we could have a mobile home where they own the mobile home and they own the land, but that wouldn't be the most normal. When they own the mobile home and rent the land, we're going to have two components. We're going to have a municipal tax on the mobile home, which is generally collected by the mobile home park. That'll be taxes. And then they're going to rent the land underneath it because they're in a mobile home park, right? And somebody owns the whole mobile home park and people rent little plots of it. But they might own the mobile home. In that case, we're going to have taxes for the mobile home that they own and rent for the land underneath it. Okay? So when we see mobile home, it's not like we run scared because it's not that bad. Just understand the different sort of permutations that there can be out there. Okay. Now, the one final thing I want to say before we just absolutely have to keep going here, and that is shared living expense. Shared living expense. This kicks in automatically when the rent paid by multiple households, meaning, we've got the 4 24-year-olds living together, right? We've got 4 households within one homestead, right? If the rent is not split equally between them, we need to do a shared living expense statement. The point of this is that you can't have, let's say even it's boyfriend, girlfriend. Boyfriend is 4 years out of college, is earning $60,000. Girlfriend is still in college and earns $12,000. What the state does not want to happen is that the boyfriend says to the girlfriend, you pay the rent, I'll pay everything else. Okay? And then by you paying the rent, you can claim homestead credit because boyfriend's got too much income. The state says, no, not so fast. We're only going to let you pay or claim rent based on the percentage of expenses overall that you paid. And so we've got really a pretty simple table to fill out here. There's really nothing within this schedule that is that hard for us to do. We just need to have an awareness. And what is that awareness, guys? It's when the rent collected divided by the number of occupants does not equal that renter's share. So let's say we had $2,400 in rent collected for the unit, and there's 2 people, there's 2 occupants, okay, and meaning 2 households. 2,400 divided by 2 is 1,200. Let's say that we had 2,400 here, we had 2 here, and we had 1,800 there. That's not equal. That division, the product of that division is not equal, and therefore shared living expense statement kicks in, and the shared living expense will determine the amount of rent that they can actually claim. Okay, shared living expense statement.
I just have a quick question about this one. This renter certificate. Did you say where it came from? Did the landlords provide it?
Excellent. The landlords in many cases will be very proactive about it, and they'll just give it to them like with their January rent statement, But often it's the tenant, kind of hat in hand, walking up to the landlord saying, "Would you fill this out?" And the landlord goes, all right, I will. But they need to bring it to us.
They bring it to us.
They bring it to us.
Before you jump to cancellation of debt, would you talk briefly about what happens if a landlord refuses to sign a rent certificate?
Yeah, and that's not unusual because a scenario like this, and that is they're behind in their rent and they got evicted, or they might even still be there and they're behind in their rent and their landlord is angry at them. The landlord sometimes sort of as retribution won't do it, and I don't really think there's any criminal offense for them not doing it. I don't know if they can really force them to do it. But in that case, we must have either, I believe, and I think I'm right on this, canceled checks or rent receipts. We cannot just simply go with the claimants. In this case, they're not really taxpayers. They're doing a homestead credit claim. the claimant can't do it without some sort of documentation that verifies.
Right, and it does have to be those. Somebody can't just bring in a bank statement showing if people are paying their rent through automatic debit, they can't bring in a bank statement. It would need to be a more official record than that.